Here's how you make money with a return on amortization, or ROA. Your ROA is like a savings account that someone else actually funds for you when you own an income property, and the formula is simple. It's the amount of tenant-made loan principal paydown divided by your equity in the property. Let's say that you make a $50,000 down payment on a rental property and you get a $200,000 loan for the rest. By doing a search for a loan amortization calculator and sticking in $200K borrowed at, say, a 6% interest rate and a 30-year loan, well, you'll see that it's about $2,250 worth of principal paydown that your tenant makes for you on your rental property's mortgage in that first year. $2,250 divided by $50K, that is 4.5%, and that is your ROA on this property. And now you can see how your ROA is like a savings account that your tenant funds for you. Now that's an income property. What if instead you bought a primary residence to live in yourself with these same numbers? Well, your home's ROA is exactly 0 because your tenant-made principal paydown is 0, since there's no tenant, divided by your same $50K of down payment or equity. Yep, homeowners have 0 ROA benefit because you had to work to pay for that money on your own principal, not a tenant. When you pay down the principal of your own home, all you did is take $1 of earned money that you had to work for yourself, and then you took that from your liquid cash pocket and you simply moved it over into your illiquid equity pocket. That dollar just moved. There was no tenant to fund your equity savings account for you in that case. And you are unlikely to find the ROA in any book. In fact, it's the only term in our Explain series that's like this so far. In our trademarked Real Estate Pays 5 Ways video series, your ROA is the third of 5 ways that you're paid. And you can get that Real Estate Pays 5 Ways video course at getricheducation.com/course. You're watching the 4th video in our Explain series, where I take one real estate investing concept and just break it down very simply, much like I did with the ROA today. So far in our series, in order, what I've explained is net worth, cash flow, title insurance, and your return on amortization. If you want to see more, when you subscribe to the channel, be sure to hit that little notification bell. That's the only way you'll be assured of seeing the next Explained series video. I'm Keith Weinhold. I'll see you next time. You can watch this one next.